Get Rich Education is brought to you by Ridge Lending Group, Apartment Investor Mastery, and Producers Wealth.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to GRE, Get Rich Education, episode 181. Hi, I'm your host, Keith Weinhold. Rich Dad Advisor Tom Wheelwright is going to be back with us here on the show in a few minutes to discuss permanently reducing your taxes. But first, I want to tell you something about real estate markets. Even in this increasingly digital world, geography still matters immensely in real estate investing. It's still about location, location, location. So in real estate investing, we often talk about how your market is more important than your property. I want to tell you a story. I'm going to call this a tale of two real estate markets, and this could be pretty paradigm shifting for you. I'm going to tell you about a place that's really bad, then I'm going to tell you about where this place is, and then I'm going to talk about another place that's really good. So, okay, for this market that's really bad, Forbes just named it the 5th most dangerous city in the United States. The FBI's latest uniform crime report just named the state that this city is in the most dangerous state in America, too. So different reputable sources agree that this city I'm describing is definitely in a bad place. The city has eye-poppingly high rates of both violent crime and property crime, and it has high rates of murder and assault and sexual abuse and drug addiction, and even rampant motor vehicle thefts. Seemingly almost every bad crime you can think of, this city has a major problem with it. Wide swaths of the city, people don't even feel safe parking their car outside of a garage or it's going to get vandalized. In fact, while year-over-year property crime nationally fell 1% in 2016, which is the latest year reported, it still rose 24% in this bad city. Unemployment has become so bad that it isn't just so bad in the city, even the state that the city is in has the highest unemployment rate of all 50 U.S. states, and no other state is even close in unemployment. In fact, both the city and the state that it's in have lost jobs each of the past 2 years, and it's predicted to lose more jobs for a third year in a row here, with no end in sight. Both the city and the state that it's in are even in an economic recession. In fact, this city's economy is so poorly diversified that even if the recession ended, they're going to be more likely to fall back into one. Homelessness is seemingly all over the place, and it is quite visible across much of the city. The state that this city's in even has a legislature that's dysfunctionally gridlocked. They just can't even pass a budget at the Capitol as they're trying to deal with dwindling state coffers. This city, topographically, is situated on what was really just a swamp at one time. And today, now it's basically just a filled-in swamp, and there are still mosquitoes all over the place. If that isn't enough to scare you about this miserable place, after all that's been said, the cost of living is markedly high on both the global and the national scale just to live there. And then after all this, the weather is just horrible in this city, even intolerable. Yes, I am still talking about a real-life place on Earth here in the U.S. today. The bad city that I'm describing, it's geographically isolated from almost any other place on the globe. It also has terrible earthquakes. In fact, a few decades ago, a massive earthquake nearly leveled the entire city. So, well, you probably don't find it surprising that the population of both the city and the state that this city's in are dropping. Outmigration easily exceeds in-migration. More people are leaving than are coming in. Commercial space in the city is increasingly vacant. People are moving out. Businesses are moving out. Investment dollars are moving out. They already have. They are just gone. So not surprisingly, commercial and residential real estate values are surely not appreciating. Besides higher vacancies, rent incomes are going down, 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 as you would expect. After hearing that, you might think that if you visited this city that I just described, you wouldn't get out alive yourself. Well, I'm going to tell you where it is. This city, which is in the United States, yes, right here in this country, right now, today, in 2018, in fact, I'm going to tell you that I am physically in this city right now myself. You might wonder if I'm going to get out alive, or maybe why you don't hear gunshots in the background or something. Well, I'll tell you where I am today. Today, I am in my chosen hometown. This is my permanent home, Anchorage, Alaska, USA. That's the bad market that I just described. And I'm a real estate investor that could live anywhere. I live right here in Anchorage by choice. I just want to let that settle in for a moment, and I'm going to tie that together with exactly what that means to you and your real estate investing in just a minute for you here. But this is a tale of two real estate markets. So now I'm going to describe a second market for you here, and then I'll tell you which second metro area I'm talking about. Now, that last one was a woefully bad city and market. I almost didn't even like talking about some of those things. Let's talk about a good market in our second city here. And I had better do it quickly before I get shot here in Anchorage, Alaska, right? The second city, the good one, okay, it's also in the United States. I'll just tell you that right off the bat. And it is one of the nation's wealthiest cities as measured by median family income. The city is pretty clean. It operates quite efficiently by a lot of measures. This good market, this second market, it has good infrastructure, no traffic problems to speak of. And besides being a wealthy city, it's also inside one of the wealthiest states with the highest per capita income. And on top of that, its residents enjoy one of the very lowest tax burdens of any city in the entire United States. In fact, Kiplinger's has named it the most tax-favored metro in the entire U.S. Of all 400 metro areas, this good market city is number one. The airport in the city is one of the most important airports, not just to the U.S., but the entire world, and it's really doing a thriving business. This good market city and its backdrop are also known for its scenic beauty. It's got close access to both snow-capped mountains and the ocean. In fact, this good city, it might have more great outdoor recreational opportunities than nearly anywhere in the nation. In fact, it's so beautiful that it's a top tourist destination, and its tourism numbers and its revenue just keep increasing year over year. And actually, the last time that I was in this good city that I'm describing to you here, the last neighborhood that I was in that city, I went to a new construction homes open house. They're doing a whole bunch of new construction in a section of the city. And as you might expect in a city like this, property values are above average for the U.S. And I could clearly see this at this new construction open house. And prospective buyers, residents, they are just snapping up homes and they're getting them under contract before the construction is even done. In fact, in this good market city, real estate values have stayed strong even through the Great Recession of 2009. That's how resilient this city was. Well, by now you're probably wondering where this nice place is, this good real estate market. Maybe you're thinking you would want to visit this place too, just like a lot of tourists do and just like I did. So I'll tell you that this good city, this second city in this tale of two real estate markets is the city where I am today. Again, it's my hometown. The good market that I just described is beautiful and pristine, Anchorage, Alaska, USA. Yes, the bad city and the good city are the same one. With facts, I just described the same place in two dramatically different ways. The high-income city with the beautiful scenery is the same one that's crime-ridden in some areas. in my neighborhood of West Anchorage, they're building new construction homes and people are moving right in. So you're thinking, you've got to be kidding me, right? How could that possibly all be true? How could that possibly all be true? A tale of two real estate markets is, in fact, not a tall tale. It is true. I've definitely never been shot at here in Anchorage. I told you this to help give you some perspective. When you hear people pigeonholing markets and saying things like, I would not invest in that city because I heard this, or I read that, or I'm definitely going to invest over there because I heard these good things there, that's not enough. You can't just brushstroke an entire city. Real estate investing is about markets, but above all that, it's really about neighborhoods and micro markets within a certain metro. So that's why on this show, we try to go behind the stories and the statistics where we can. And that's also why we rely on trusted turnkey providers that actually operate in these local markets and know which areas to rehab and which areas to stay away from. This is why your team and property manager are more important than your property itself, too. So there it is, a tale of two real estate markets. Well, Tom Wheelwright is back on the show with us once again as we're squarely in tax season here. We already discussed the Trump tax changes a few months ago when he was here. And remember, those changes, they generally affect your 2018 taxes, meaning the ones that you'll prepare by April of 2019. Yes, those Trump tax changes, like how you can no longer do 1031 exchanges with cattle, but you can with real estate. And we discussed the new limits to some of the deductions that you can take. And we discussed all those things the last time that he was here back in late December. So since that's already been discussed, we're moving ahead. We're going to talk about what today's tax rates actually are in terms of percentages. We're going to start talking about some history, too, to give you some frame of reference for just what the past, the present, and the future of taxation might be, since it's your biggest expense in life. Historically, remember, income taxes did not always exist in the United States. We'll chat about how home flippers pay higher tax rates than long-term buy and hold real estate investors like us. With turnkey real estate investing, remember, you are buying someone else's fix and flip in an investor advantage market. And then this way you get the preferential capital gains tax rate, not the higher rate like the flipper does. All that and more. Let's bring in Tom. You likely already know who today's guest is because he's a regular contributor on permanently reducing your taxes here at Get Rich Education. He is the founder of Wealthability. He's the author of the best-selling book, Tax-Free Wealth. That's part of the Rich Dad series. And he more recently authored the book, More Important Than Money, along with Robert Kiyosaki and the Rich Dad Advisors. Welcome back to Get Rich Education, Rich Dad Tax Advisor, Tom Wheelwright.
Hey, thanks, Keith. It's always good to be on your show. I love what you're doing. I love the financial education that you're giving your listeners.
Well, Tom, you know where it all starts when people think about taxes? A lot of times they think about their paycheck, and what happens to so many people's paychecks at their W-2 job? The money goes to the government first from whatever they pull out of there. It goes to Wall Street second if they're making a 401k contribution. So it really only goes to you third at best. What are your thoughts?
Sounds to me like you're just getting what's left over. And I don't know about me, but leftovers, they're okay, but they're not my favorite thing to eat. I'd much rather have a fresh serving, and I'd rather have my money come out first.
Those leftovers have gone cold as well. But I think that we all know that tax rates, historically, they just sort of continue to rise. But with respect to this income tax that comes out of your paycheck, back in the 1800s, income taxes were actually meant just to be a temporary tax to fund war efforts and then go away after the war effort was funded. But its constitutionality was widely held in doubt until 1913. And 1913 is when we had the ratification of the 16th Amendment. So about the federal income tax here since 1913, over 100 years ago. I might just refer to it as 100 years ago to look at where we've gone from with the federal income tax rate since then until today, the present day, 2018. So back 100 years ago or so, 1913, the top tax bracket was 7%. That's if you were a high income earner, it was 7%. Today, it's 37% for 2018, those returns that are going to be done in 2019. Trump actually brought that down a little bit. I believe it was 39.6%, and now it's 37%. So any thoughts on the history of the top tax bracket that Americans had to pay, going from 7% up to 37%?
Well, yeah, I'll go one more with you. Employees didn't even have to pay it until 1944. So the current Withholding Act in 1944 is what made employees subject to it. And even when they were subject to it, they gave an exemption that was equal to the average standard of living. Okay, so remember our personal exemptions? That used to be an amount equal to the average standard of living for the average American worker, which means that, I mean, you're saying that, yes, the income tax started to apply in 1913. But for your paycheck, it didn't start applying until 1944, and actually didn't apply much until actually long after that. Really, in 1954 was, the big tax reform, and it was in the 50s that we started seeing it apply to employees.
So it was really the first 30 or 40 years of an income tax at all that most people had to pay it.
Right. The first 30 or 40 years, most people didn't have to pay. It really was a tax on investment income and on the wealthy. So it was only a tax on investment income, the wealthy. It's so interesting, Keith, that you bring this up, because the income tax, not just the U.S., but other countries as well, because they're very similar to us. Income tax kind of flipped on its head, where it used to be a tax on the wealthy. Now it's a tax primarily on the middle class. It's a tax primarily on the employees and the wage earners, and not as much on the investors and the business owners.
Right, because those that behave the way the government wants us to behave within the tax code typically are those people that are doing things like real estate investing and other things outside of their day job that help the economy, and that's why the middle class get disadvantaged.
Well, that's right, because the government learned really in the early 60s that the U.S. government did an experiment with the investment tax credit, and they learned that a small tax incentive goes a long ways in encouraging people to behave a certain way. And then they started really managing the economy. It was really in the 60s, 70s, 80s. They were really managing the economy, and they figured, well, look, if taxes have such a big impact on people, and if they'll take such big actions just for a little tax break, then we ought to use the tax law that way. And really, the tax law has become a series of incentives. And really, I would say 99% of the tax law is a series of incentives. And by the way, not just in the U.S., but around the world, and primarily for professional investors and business owners. I mean, that's who the government says, we're going to give you incentive if you do what we want you to do. Exactly right. And what we want you to do is we want you to build business, create employment, and create housing, and do other things. I mean, energy has tax incentives. Agriculture has tax incentives. I mean, heavens, with this new tax law, having children has tax incentives. We have $2,000 tax credit. So there's actually tax credits for social activities as well. I mean, like sending your children to college, right? You get a tax credit for sending your child to college. Well, that's an incentive to send your child to college.
Right. Just looking at the history of the income tax some more. So we used to have a top tax bracket of 7% way back in the day, which you just told us that most people didn't even have to pay in 1913. And today, the lowest tax bracket is 10%. That's for the poorest among us. That's the lowest.
That's exactly right.
Yeah. Now, if you look at the top tax bracket threshold, going back up to the top, this is in inflation-adjusted dollars. The top tax bracket is $11.8 million back in 1913, just to give you an idea of how few people really had to pay this, which you touched on before. And today, the top tax bracket, before you tilt into that 37% marginal federal income tax bracket, it's $500,000 for a single person or $600,000 for married filing jointly until you have to pay that highest rate. So that's come down. That threshold's come down significantly as well.
Yeah, for sure. There's no question that the governments have really built, like you said, originally taxes were supposed to be temporary. Even in 1913, they were meant only for war. I mean, that's really what they were meant for. And that's why they taxed the rich at that time. And that's why they only taxed the rich, is they didn't need a lot of money. You know, I mean, understand what happened in 1914, World War I, right? So, you know, the income tax, they looked at it, they go, look, what happens when we have a war? We don't always have to come out with a, war profits tax or something like that. We'd like to have something that's permanent so that we can raise revenue more easily and have the funds available for the government. certainly when the 16th Amendment was passed, it was never thought that it would become part of our daily life.
Right. And more government has become part of our daily life. Back 100 years ago, the total tax revenues, again, this is inflation adjusted, was $17 billion. That's a total tax revenue. Today, it is over $3 trillion per year. That is 175 times more total tax revenue than it was 100 years ago. Okay, but you might say our population is higher now than it was 100 years ago, of course, but our population is only about 3 times greater than it was 100 years ago, but yet the total tax revenue is 175 times greater. Adjusted for inflation, government is just bigger.
It is, and all it says is that, you know what, is now more than ever, it's our duty to do what the government tells us wants us to do. And if we do that, then we're going to lower our taxes.
You know, Tom, something else I have read is that back in 1913, there were 400 pages in the tax code. And then today there are how many pages in the tax code?
6,000.
That's astounding. So that's what, 15x there. Yeah, that's just crazy. But again, yeah, if you use it to your advantage, you know that many of those pages are a treasure map toward getting the deductions. And, you know, back in 1913, they didn't distinguish between an income tax and a capital gains tax. So before we talk about capital gains tax, just any other thoughts about the income tax and the history of it, or where you think the future of it is going?
What we see around the world is there's a lot more emphasis on Social Security taxes. So we have a Social Security tax. It's a maximum rate of 16.2%. Germany has a Social Security tax that is upwards of 40%. So I think what we'll see is, and I actually think that's the next big tax revenue raise, is taking the cap off of Social Security. So we think of Social Security as part of our income tax. It's not really technically. It's an excise tax. It's a tax on earning, on wages, basically, and earning money. It's a tax on working. I think that's actually where we'll go. The tax rates, interestingly enough, around the world hover around 40% for the highest earners. Now, you know, where that starts is different in a lot of countries. I mean, like South America, that's going to start at around $50,000, $60,000, that highest rate, because they don't make that much money down there. Their standard of living is just so much less than in the U.S. I think we're going to see for the foreseeable future something in the 40% range, 40 to 50%. If it gets over 50%, it's a huge negative incentive, a huge disincentive to work. If it gets over 50%, if it gets under 30%, then there's not then the tax breaks, you know, these tax incentives they give us don't have as much meaning. Frankly, once it gets under 25%, for most people, they have almost no meaning at all. So like at our company with our tax-free, and we'll talk about this, but our tax-free wealth network of CPAs, at our CPA firms, we target about a 20% rate. That's what we're looking for. If we get much lower than that, it's just because somebody has a lot of real estate, you know, certain type of investments. But the reality is that tax planning stops making a lot of financial sense once you get down below that 20% bracket, you know, a lot of tax planning. So I think the governments will probably keep it in that 30 to 50% range for years and years to come.
Okay. And when you're talking about these percentages, are you talking in effective tax rate? Are you talking in income tax rate? Which rate?
I'm talking about marginal tax rate.
Okay.
So you're 37%, okay, which was 39.6% last year, right?
Right.
37% this year. The marginal rate's been as high as 90%.
Right. For example, in World War I, they really raised it up high temporarily to fund that effort.
Yeah, actually, some of you talked to your grandparents about this, but some of you may remember Jack Benny, who was a comedian. And Jack Benny was in the 90% tax bracket. And we actually have a tax law that's still on the books that is a direct result of Jack Benny's tax planning.
Okay, he contributed in a place we didn't expect him to contribute.
Exactly. More than just a violin.
Yeah. Well, interestingly, you know, before we talk about capital gains tax, you mentioned Social Security tax. And, you know, a dollar earned from your job, a dollar earned from your paycheck, importantly, that is taxed differently than a dollar of your real estate cash flow. Okay, so first, it might be sheltered from ordinary income tax due to depreciation when you have a dollar of income from that real estate cash flow. And then additionally, a dollar of real estate cash flow, that is exempt from Social Security tax and self-employment tax.
That's exactly right. So again, Social Security is for the social security of individuals. It's really intended to be a retirement payment. Okay. That's what it's supposed to be, is a retirement payment to give you the minimum amount that you would need. It's supposed to be.
Right.
I mean, it used to be better. Okay. But it's supposed to give you the minimum amount that you would need to live on. Okay. So that none of our elderly people walk around without money. Now, remember that also when Social Security came into effect, was also in the 1930s, 40s, the average person, their lifespan was 65. It was like 65 or 70, right?
Right.
It was a much shorter lifespan. So nobody expected that people would be on Social Security for 20 years. So what's happened, of course, is now people are on Social Security a lot longer. That, they start getting it when they're 66 now. It keeps going up, 67. It actually should go up. It should go up quite a bit. It should probably be around 75 by now. But in any case, it's about, let's make sure those workers who have worked, we're going to tax them on this money. The first people who took money out of the Social Security system didn't pay anything into the Social Security system.
Right.
Because it started and everybody started then paying in, but also a whole bunch of people started taking money out.
The demographic problem, yeah.
Exactly. And so as the population grows, of course, that it's problematic, but it actually solves an issue. I mean, it's problematic for the people who are paying it because there's more and more people paying it. But remember, you're funding less people than are paying in. So I think that's actually part of the idea behind it. As population grows, you always have money in there. So we'll see. We'll see what we have. People say, well, we should have, Social Security would go away, et cetera. Social Security is never going to go away. What we see in other countries is that Social Security just gets more and more. Okay. So most countries, for example, we don't have a requirement to put money into that 401k, right? I mean, it's our choice. In most countries, it is not their choice. Okay. They have to put money into their version of the 401k. They don't get to choose. And they also have Social Security taxes on top of that. And employers pay a much higher Social Security tax in many countries as well. So, I mean, right now, if you look at that top tax rate of 37% and you add in even just the employee share, 7.65%, well, it's actually more than that because you add that 0.9%. So it's about 8.5%. So if you add 8.5% to there, really the top rate right now is 45%. Okay. When you add in Social Security, the top rate is right around 45%.
Right. We're talking about the Social Security tax on top of the federal income tax. And of course, we haven't even mentioned a state income tax that might be on top of that yet.
Right. I mean, you have state income tax, which, as we know under the new tax bill, is not as deductible anymore as it's been, at least until the states figure a way to wiggle out of that one. So we have a state income tax. There are no state Social Security tax yet, but, employers pay a lot of other taxes. They pay unemployment tax. They pay workers' compensation. So there are yet additional taxes that you're not seeing, but the reality is you're paying because your employer could be giving you that money instead of, paying it to the government. So there's even a lot of hidden taxes that we don't see.
Donald Trump gave us a reprieve on taxes in some places, but we've been talking in a historical context here about what's happened with tax rates over the last 100 years. They generally just keep going up, up, and up. Social Security doesn't keep up with inflation. Maybe it keeps up with the CPI, but not the true diminished purchasing power of the dollar. And yet you're getting those Social Security payments, the first payment coming later in life. All this, and at the same time, the pension has largely been replaced by the 401k. That's why you need to listen to shows like this. You're listening to Get Rich Education. We're going to have more with Wealth Abilities. Tom Wheelwright when we come back. I'm your host, Keith Weinhold. For an income property investor like you that needs an income property loan, go to Ridge Lending Group. And over the years, you've heard owner Chaley Ridge generously give her time to you right here on the show as a guest. Ridge provides investment property loans in almost every U.S. state, and you're going to find out how they've helped more Americans realize their dreams of financial freedom through real estate than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president of Producers Wealth. Producers Wealth assists people in creating, protecting, and perpetually multiplying wealth in any economy through creating processes that help them increase their production, provide them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com.
This is Rich Dad Advisor Darren Weeks. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education with Tom Wheelwright, Rich Dad Tax Advisor. Check out Tom at wealthability.com. Tom, so back in 1913, there really wasn't any distinction right away between an income tax and a capital gains tax. I think the capital gains tax came along a little bit later. So just tell us about the history of the capital gains tax and, first of all, what capital gains tax is.
This is good to talk about, Keith. A lot of people don't really understand what is capital gains tax. Capital gains tax is not a separate tax. It's a different rate for certain items, okay? So when you look at the income tax really breaks income into different categories. And one of those categories is what we would call investment income, portfolio income. And that income is taxed at a different rate, okay? So it's actually better income because the rate is considerably lower. It's about approximately 50%. Right now, it's approximately 50% of your regular income tax rate. So if you're in basically a 40% bracket, you pay a 20% rate. If you're in a 30% bracket, you pay a 15% rate. And you can pay as low as zero on capital gains if you're in a low enough bracket.
Yeah.
That's not always been the case. Like you said, I mean, actually it used to be that investment income was the highest taxed income. I mean, investment income was the income that was, in fact, I believe at the beginning, investment income was the only income that was taxed. So capital gains rates came into effect. You may have done the research. I can't remember how far back. I do remember, though, because I was actually around in 1986. What we used to have is a deduction is what we had. So rather than have a different rate, what we did was we got a deduction if we held, we had long-term capital gains. Now, here's basically what we're talking about. You hold something for investment, and this is very important. In order to get capital gains treatment, you must have an investment intent. Your plan is to hold it for investment. Let me give real estate as an example. Let's say you buy a single family home and you put it on the market immediately, knowing that you're going to renovate this, knowing that you're going to go in and you may even plan to put a renter in. You put it on the market immediately. You've just changed your intent from investment to inventory. And now that property is actually inventory, and it is ordinary income. It is not subject to the capital gains rates. It's even subject to Social Security taxes.
Now, we're basically talking right now about why flippers pay higher tax rates than one that holds it for long-term investment capital gains.
That is correct, because what you've done is what the IRS says, clearly your intent is to market that property. Clearly your intent is to sell that property. And when we have something that we market to sell, and that's what we do with the property and we keep doing it, what do we call that? We call that inventory. And now you're in a regular trader business. You're no longer in an investment. You're in a trader business. So you're in a business, not an investment. So what the IRS looks at, and this has been the case since day one, well, when we've had capital gains rates, is they're looking at what's your intent. So here's what you can do. On the other hand, let's say that you take that same property, you buy it, you start fixing it up, and your roofer comes to you one day, and he's fixing the roof, and he says, man, I love this house. I love what you're doing. I'd like to buy it from you. Well, your intent didn't change. You didn't market that property. So that is still capital gain. Because you're selling it within a year, it has to be held for a year and a day to get the long-term capital gains rates. You're taxed at short-term capital gain, which short-term capital gain has the same rate as ordinary income,
right,
except you don't pay Social Security taxes on it. So even that is better from a tax standpoint than marketing it.
That was really well stated. I'm glad you brought that up. In Trump's recent Tax Cuts and Jobs Act, which was passed at the end of last year, so that affects 2018, just to review some of this stuff, long-term capital gains are properties or investments you've held for 12 months or more. So those are taxed at those lower rates that you touched on, Tom, either 0%, 15%, or 20%, depending on your tax bracket. And those are all lower than ordinary income tax rates. And yes, long-term capital gains tax rates, you're right, your income must be pretty low to get that 0% treatment. After you have made $38,000 of income per year, it goes from 0 to 15%, and then it doesn't go from 15% up to 20% until you make over $425K for a single, $479K for married. So again, we're just talking about long-term capital gains tax rates here because, as we stated earlier, short-term rates, they are just taxed as ordinary income. You know what's so interesting, Tom, is that people that invest in 401ks, well, they're investing for the long term. So after they're in retirement and they need to begin making distributions between age 59 and a half and 70 and a half, and as we talked about before, they must start paying tax on those 401k distributions at that time. Well, interestingly, they've held them inside a long-term investment. So you would think that that 401k investor would get the lower and the more preferential long-term capital gains tax treatment that I just explained. But they don't. They have to pay ordinary income tax rates in retirement, which are typically higher. So this is another way that 401k investors do not make out very well. So tell us why that is.
Because you also get a deduction against your ordinary income going in. So it retains its character. So you got a deduction going in against your wages, right? It came out first. So it came out of your wages. You're not taxed on it. So you got a deduction against your wages. So when it comes out, and that was ordinary income, so you got an ordinary deduction. When it comes out, it's ordinary taxable income. But here's the point that you really highlight, Keith, is that what are you doing with the money in your 401k? You're probably investing it in something that had you invested outside of your 401k would have been taxed at long-term capital gain rates. So mutual funds, stocks, some people will even do a self-directed 401k and they'll invest in real estate. I don't know why, but they will. And so what happens is you've really turned long-term capital gains into ordinary income by doing the investing within the 401k.
Well, we talked about quite a few tax rates here and just got an update on just what rates are, mostly with respect to ordinary income tax rates and capital gains tax rates. So that's the past and the present. What do you see for the future? I mean, usually when you look at the trajectory of something, you go ahead and maybe lay a ruler under where we've gone from then until now. Do you think we can continue to lay a ruler underneath them and they're just going to continue to generally rise higher over time? What are your thoughts about future tax rates, both types?
You know, I think the capital gains rates, they've settled. They've been effectively that rate in that 15 to 20% range for 40 years. So I think capital gains rates in the U.S., and by the way, again, I travel a lot, and so I check out tax laws in lots and lots of countries. Most countries have a capital gains rate about half of the ordinary income rate. And really, it's to stimulate long-term investment, right? That's the reason behind it. They'd like you to invest for the long term. It creates stability in the economy. Frankly, it's the better way to invest, right, than short-term investing. Unless you're really, really, really skilled and talented, it's a much better way to invest. So they want to encourage that. I don't see that changing. I think for income tax rates, again, as I mentioned earlier, I don't think you're going to see the top rate ever go below 30%. And I would be surprised if you see it go above 50. Again, that 40% range, it did go below. Remember, I don't know if you recall, but back in 1986, it did drop below 30% for a very, very short period of time. Okay, it was like for a year or two, and then they raised the rate again. So it's like there's a boundary at 30% seems to be a bit of a boundary on the low end, and 50% seems to be a bit of a boundary on the high end. I think that it's just not that elastic. I think that once you get over 50%, people will just stop working. They're really hesitant to put that much more effort into it. If you think about it, if you had a 50% income tax rate federally, and then you had, say in California, you got a 13% state rate.
Gosh.
So now you're up to 63%. And then on top of that, you're paying a 16% Social Security tax rate, right? Now we're up to 80% tax. Well, who wants to work for 20% of their money? I mean, I don't.
I don't know that I could.
I just wouldn't do it. By the way, they're seeing this problem in Finland. All of the income is earned and taxes are generated by 40% of the working public. That there's 60% that are, I think I've got those numbers right, that there's 60% of the public in Finland that is on some type of government assistance. And that's a really high rate. And you got to think, well, how long do you keep that up? I'm a big fan of Ayn Rand and Atlas Shrugged. And I just know that for me, I'd be thinking long and hard about the efforts I put in if my tax rates got that high.
Yeah, that's astounding when it really changes people's behavior. We've been talking about the past, present, and future of the tax law with Rich Dad Advisor Tom Wheelwright. Tom's going to come back on the show with us again. He's going to talk more about what he's talked about with us quite a bit in the past, and that's just what exactly you can do about it. And the short story is that you can be a real estate investor where you have direct ownership and control of your own property. But Tom, you're with Wealthability now. Tell us more about that.
So Wealthability is an expansion of our company, Provision. Provision CPA firm. And what Wealthability allows us to do is really expand into really providing more services for more people. So on the one hand, we're going to provide more tools, more education, even software, iPhone apps. We're working on all of those. We have a very short-term plan to actually have a lot up and running with the near future from an education and assistance tool standpoint. And then on the service side, we're creating a entire global network of tax-free wealth CPAs. So it's called the Tax-Free Wealth Network. And we have two firms. We have Provision, and we have my little accounting firm called Wheelwright Manahan. We're the first members of Tax-Free Wealth Network. We already have CPAs in Australia, Hong Kong, Singapore, Germany, and Mexico that are ready to come in to us. And we have several CPAs in the U.S. that have also expressed interest. So our expectations, we will be rolling this out. We'll be gathering our CPAs together. And I think it will be able to allow us to provide a much broader range of services to a much broader range of people. Obviously, Provision's a very elite CPA firm, and people know that when they work with Provision. I know you work with Provision, and it's a fantastic CPA firm.
Yeah.
And if you want to get a little more elite, then you come to my CPA firm, which is even more expensive than Provision. So what we're not serving is that 40%, 50% that really, aren't quite ready for Provision yet. We want you to be able to have something in your locality as well. We're really developing this global network of CPAs that will allow a big community of CPAs. We're out to, frankly, Keith, we're out to change the CPA profession. So we don't have our sights set very low. We are out to change the world. But the thing that I love about what you're doing is that Wealthability, that comes from your ability to create wealth. And that's what Wealthability is all about, is it's your ability to create your wealth, not relying on, I know you've got this big thing like I do about Wall Street, and you hate Wall Street and you hate the mutual funds. And I do too, because you're turning your money, hard-earned money, over to somebody else with the express idea that they're smarter than you are to handle your money. And that is just a lie. They are not better than you are. You can handle your money better than anybody, and nobody cares about your money like you do.
You can help maintain control over your taxes and your income at wealthability.com. That's a great place to start. Tom Wheelwright, thanks so much for coming back onto the show.
Thanks, Keith.
Oh, yeah, more great material and great energy from Tom Wheelwright. At this point, for the first time, I think I've lost track of how often Tom has been here at GRE. If I hosted him more often, Tom would almost be the co-host of the show at this point. We love him. It is a rare trait to make taxes fun like he does. We're all rooting for Tom and want to help him change the industry with Wealthability. Check out Tom and wealthability.com. Next week, I expect that we're going to continue our irregular feature of having an everyday GRE listener just like you come onto the show so that we can learn about the impact that Get Rich Education has had on their life. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
If you want to retire in 5 years or less through real estate investing, then pay close attention as I'm about to share my proven recipe with you. This is Brad Sumrock, and I've taught thousands of people just like you how to replace their incomes, quit their jobs, or simply have more income and freedom than they ever thought possible. And we do this by investing in apartment buildings. After starting with no experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job after only 3 years of apartment investing. and I have hundreds of successful students that have had similar results. If you want to get out of the rat race or simply have more income and freedom in your life, then investing in apartment buildings might be the answer for you. Visit our website at bradsumrock.com to get more information about our upcoming training events. That's bradsumrock.com.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.